What is going on, everybody? David Ramsden-Wood and Mark Rossano here for another pregame. Cold game, perhaps, as we're going to start this week's episode talking about what is going on the power grid in Texas. There's going to be a lot of narrative from both sides coming. And Mark, I wanted to start with what are you seeing, and if in the debate of the wind isn't working versus the natural gas isn't working versus the nuclear isn't working, where are we at and where are we headed with this power crisis in central United States and Texas?
You know, right now, I think we have to simplify it into what is base load and what is peak load. And base load is just something that doesn't go off. It's on constantly, that which typically you'll have coal and nuclear, which will be defined as base load. Hydro, well, depending on the type of hydro, would also be base load. And then you have a certain amount of natural gas, which can also be base load. Again, the reason why that's so important is when you start thinking about renewables versus peak shaving, which has always been natural gas, you have an issue coming up. And that's where, as the base load shrinks, which has typically been, especially in this region, coal and nuclear, as that shrinks, all of a sudden you have to pull in more peak. You have to increase this intermittent demand, which doesn't have the same type of stable supply. So now all of a sudden you're pulling harder from what is really spot natural gas off the pipeline, which is classified as pool gas, versus what is already spoken for. So when you have these extremes, the system just isn't able to do it because the base load doesn't provide that core cushion that you need to meet this new demand.
So, and I think about it two ways, right? Because obviously, Texas is not built like Canada. So there's other contributing factors, but in Canada you have heat trace, you have dehy units, you have lower water in the gas, you don't have surface lines. So there's a lot of issues that you can build natural gas infrastructure for more cold weather. And so right now we have, not only do we have wells down because of freezing, we also have the refineries. I think it's more than 5 million barrels a day of demand on the coast is also down to conserve power because it's industrial use versus residential use. So now there isn't a place for new oil to go per se. So there's a hit on demand, oil wells shut in, nowhere to truck it, and that exacerbates the issue. So gas is down about 10 BCF a day because of all those problems. And wind is generated because the wind blows, not because you want it. So you have a lot of exacerbated factors. What do you make of how ERCOT, the power supply company, and SSP, the Oklahoma 14-state collaboration, how have they been dealing with the crisis, in your opinion, and what comes from this in the next week or two?
Well, how they've been dealing with it has been a problem in terms of, instead of trying to say, we're sorry, and then this is how we're going to fix it and address it going forward, it's been kind of a mishmash of a comedy of errors, if you will. But now they're starting to finally assemble power to pull from other regions, which is also creating a knock-on effect as other areas, going essentially from Texas to North Dakota, are experiencing this extreme cold, which again is pulling a lot of natural gas out of the system because you have this big increase in the demand factors. But as you talked about with a lot of this capacity, not only are they worried about power, but you also have the equipment that isn't prepared for it. So you have the pipelines, as you talked about, with tracers. A lot of them are above ground instead of below ground. You also have generators, you have transmissions, you have things that just really aren't built for this kind of capacity. And then when you look at, okay, well, Canada also has, wind. Why is Canadian wind different? And it's like, okay, well, they insulate their generators differently. They put special resin on their blades so that the ice buildups are much smaller. And these are things that are done. But even in the extreme weathers that we've seen, especially in Canada, they freeze up as well, because you have the issue of the wind not blowing, but you also have the problem of generators that are frozen. And it can work both ways. If the wind blows too fast, there are also governors that mitigate how fast the actual turbine can spin, because it can actually vibrate itself to pieces. So there's all of these different problems that can come aligned. But when you look at renewables are that are expected to be base load, have short cycle gas turbines to backstop them. So if the wind doesn't blow, short cycle, which is deemed anything that can turn on within 3 hours, because a coal plant will take anywhere from 24 to 48 hours. So you have short cycle gas coming online. Wind fails, solar fails, natural gas turns on. Now that natural gas turns on and off at an intermittent level. So they don't have a spoken for demand on the pipeline. So when they pull from the system, they'll get the gas immediately, but because it's so cold and so many people are pulling natural gas, it leaves the system quickly. You can't pull it from the. You can pull as much as you can from storage, because when we look at it, and I actually have the figures here, we have 7 pounds of water per million standard cubic feet, and in Canada it's 4. So we don't have an issue on treated gas. It's to your point of the untreated gas, or the gas coming out of the wellhead, which still has a lot of water in it, haven't gone through hydronation systems, which is causing these freeze-offs, because again, they're not prepared for this. So these are things that we have to look at of what is base, what is peak, and where do renewables fall within that setup.
Well, I think it sets up a really good conversation, quite frankly, go forward, because, I think, and I'm going to get on my soapbox for a second. All energy is good energy. And we talk about climate change and wanting to not have an impact on the world. And we talk about how cold weather events are climate change and warm weather events are climate change, and wind and no wind and sun and no sun. It's all climate change. But the reality, we have 7.8 billion people who are modifying their living environment to live in higher comfort. And that's what we choose to do. I was in Omaha, Nebraska over the weekend for a hockey tournament, drove by a coal plant. 60% of Nebraska's power is brought by coal, and there were no restrictions whatsoever because coal doesn't freeze. Coal, like the system is built for it, and we don't have this huge cycling. And the answer is not wind, it's not solar, it's wind and solar and nuclear and gas, because we need energy for our lives. So it'll be a very interesting story to watch. It has
before we go on too, you have to think of like Germany's building coal. You have Japan building 22 coal facilities as they're scared of bringing nuclear back with Fukushima. And with what we're trying to do on the private equity side is looking at what you just described is the basket approach. It's not one or the other, it's all of them. And how do we come up with the right means, which is why I keep harping on that base load versus peak load, because we really need to appreciate what that requires, especially when you start talking about things that don't have the same type of freeze-off capacity.
Well, and it tees up really well that Oklahoma and Texas are the center of this. And Oklahoma and Texas, both governors signed executive orders overruling the Biden executive order. And so they are aware of the energy demands. I'm complimentary of what Oklahoma's done to help diversify the grid. But there are challenges with that. And so no two better states are better positioned to deal with it. Now, the knock-on effect of this in the spot market is we've seen huge power price surges, huge natural gas price surges. We're over $3 an MCF. We're over $60 a barrel. We had been talking about, does it hit 55 before 50? Does it hit 3 before 250? We've now blown through both of those targets. And in the background, we see the 10-year Fed Treasury interest rates have crept up and pretty aggressively in the last 2 weeks. How are you thinking about commodity prices right now, and in particular inflation in the U.S., which seems to be rearing its head in a big way?
So when I look at inflation, that's one thing that we've been talking about when we start looking at leading indicators: prices paid, prices received, where rents are going, where commodity prices are. You just have to look at grains and take a trip to the food store to realize that there is going to be a bigger problem overall. Now, when you go further down that list and you start looking at used cars, car sales overall over the last 12 months, you've seen a surge in pricing, which has abated a bit, but you're still looking at a net large increase in terms of pricing in general. Then when we start looking at cotton, cotton has started going limit up, which just means that it's going to the exchange limit of pricing, as we're seeing cotton acres turn into food acres, and we're starting to see people buying clothes because they haven't been to the office in how many months. So all of a sudden, you're starting to see inflation in places that we normally don't see. Then take that to the next level. Let's look at the semiconductor shortage. Let's look at tin, quartz, silica. All of a sudden, you're getting these commodities that are moving up, and there's these net shortfalls in semiconductors where you're starting to see tech prices start to price up. These are things that are just weighing on what is happening on the inflation spectrum. And as you experienced in your airline fiasco, in February, we had a price increase. Why? Because we took capacity out of the air and it's winter break. So we naturally had an increase in flights, and winter break or spring break for some, depending on where you are, is when you see price increases on airline tickets, and they're trying to get whatever they can possibly receive. And then as you mentioned with crude pricing, as feedstock prices go up, so they tried to push through as much as they can on the back end in gasoline, diesel, jet fuel, which is also increasing prices. So the net effect is we're seeing this problem. And then when we talk about, as the U.S. 6-month bill, the bid to cover ratio, like let's just say like the U.S. 3-month bills bid to cover ratio came in at 2.72 versus the last auction of 3.02. Then you talk about the 30-year, which the bid to cover ratio came in at 2.17 versus a previous 2.4. Now, why does that matter? It matters because that's how many people are coming in to buy these bonds at a specific rate. Now, the 30-year, it was up a full basis point versus what was expected, and you had a lower bid to cover ratio. Now, it's not as low as we've been. We've been as low as 1.97, and that was when we actually had a correction in equities, because they're starting to get this, well, I'll buy your debt, but I'm not going to buy it at the rate you want me to buy it at. I'm going to buy it at the rate I want to buy it at because there's an inflation problem. There is an increase that's coming. Now, turning that into commodities, the paper market and physical market, you can drive a truck through it at this point. We have euros trading at a 10-month low. We have Congo cargoes that have 7 that can't clear. And this we're already mid February, and they can't clear April. And typically, you have that going into Europe and going into China at this point. You have Angola, which is struggling to sell some of their cargoes at their normal pace. Nigeria, all of these things in the underlying physical market is a problem. Now, on the other side, the North Sea has been a little bit stronger, but we've seen a lot of guys playing, especially Shell, of the paper versus physical market game, which can help adjust that, as Libya is now back to over 1.2 million barrels a day.
Yeah, it's complicated because we have this inflation surging. We have a time where microchips could be more expensive, and that this reversion of everything has been getting cheaper, more expensive. We have the trade war between China and the United States. We have the WHO investigating what may or may not have happened with Wuhan. And I think one of the 2 articles you've written recently for Hot Take of the Day in particular talks about inflation and China. And when I think about China, what about rare earth? Because we keep talking about renewables, and when do we start becoming so nationalistic that we hoard grain, hoard minerals, hoard oil, hoard gas? And when I think about the 90s, especially the early 90s and the Middle East tensions, geopolitical tensions come because of resource constraints. And I think we're starting to see that. What comments would you have on that right now?
Well, we made a video about a month ago about what was happening with China, where they actually issued protocols on when they would actually restrict rare earth exports. And we saw what happened in 2009, 2010, 2011 with the fight between China and Japan on the export of rare earths. And then we actually did another show looking at, well, who controls it and where is the bigger risk? And when we think about what goes into our military equipment, what goes into our EVs, and what goes into our renewables, a lot of that is rare earths. So right now, China hasn't officially said it, but they're looking at the 17 rare earths that they export as a means of limiting or restricting based on what goes into an F-35, all the way down to what goes into a solar panel. So we have to think about how are we going to offset that, and why is that so important? Well, Our phones, our computers have high-powered magnets in it. And that is one of the biggest issues, which is why when we look at, the mines that we have in California, which are starting to come back online, because we need to diversify some of that flow in order to not be beholden to China and their rare earths, because we have rare earths around the world. I mean, they're rare in density per square foot, but it's they're not rare in that sense. In the sense they're all throughout the world. It's just, where do we have enough of that density to make it economic to mine? Which is, there are parts in Australia, there's other parts in the U.S. So this is where I think we have to start getting more aggressive on diversifying those supply chains.
Where is China in terms of their debt? We talk about their debt a lot and their financial situation and the pegging of currency. And when you think of China and the upcoming potential crisis, you talk a lot about debt. Can you give an explanation of that? Because I know you're going to dig into it more this week on the show.
Yeah, so the problem with China so far is that they have about 267% of GDP in debt. Once you throw in financials, you have about 360% debt to GDP ratio. So a lot of individuals will say, look, a lot of this is internal. It lives within their system, so they can manage it more. But when you look at how they've turned into the international market to increase their bond market and open it up to others, and then when we start looking at the defaults that have been increasing on their international investments, whether that be under the Belt and Road Initiative and or just in terms of banks looking to invest abroad, you now have a lot of exposure because you have a collateral issue, which is becoming a bigger and bigger problem because the collateral is showing to be worth less. So as the collateral is worth less, you have to pledge more currency behind it, which is what they've used their FX reserves for and what they've continued to use the yuan for. Now, the PBOC has been looking to take some of this debt out of the system, take some of this liquidity out of the system. But every time they do that and they start to see an economic slowdown, they quickly reverse and inject that back into the system. We saw that with Shibor. We saw that with the credit impulses into the end of January. And all of these things continue to show that they need this debt juice in order to keep things going, to keep the charade up and coming as they continue to use the government debt to try to push the next narrative. Now, the other problem is a lot of these banks have leverage ratios that are over 30%. And I should say 30 times. And when you think about Lehman failed at 28 times. Now, how have they strengthened their balance sheets? Well, they've issued perpetual bonds. Well, by issuing perpetual bonds, who bought them? Other banks. So not only are you lending to each other in the overnight through Shibor, but now you own each other's bonds and they're perpetual bonds, and you're using that to solidify your balance sheet. So all of a sudden, you're just increasing the interwoven network of risk. And we saw what happened in 2008. We saw what happened in 2011, and how you can have this cascading domino effect that is very hard to stop once it gets going.
So Mark, we'll close here, but what I'm hearing is interest rates are creeping up. Debt is high and getting higher, which is negatively impacted by interest rates. We're seeing inflation across all forms of commodities and goods. We're seeing it in some of the things that got cheap because of demand, and now that we're expecting a roaring 20s comeback. We're seeing all these challenges, and yet the market doesn't care. Right. What changes that cycle, or does this cycle just continue in perpetuity? Has the business cycle changed forever?
So the central banks need perpetual motion, and that's what the constant move is. They need to keep everything moving in one direction to keep the momentum moving up, and I really think rates is where you see that the air being let out of the balloon. So when you turn to commodities and what happens there, the physical market and paper markets have been very different and disconnected in different ways. And that typically corrects itself as guys take advantage of it. But what stops people or machines or fund managers from increasing their equity allotment is really going to come down to rates. Where are real yields versus nominal yields? How does that start to collapse? And we still have that disconnect between the CPI, those leading indicators that go into it going up. You see real yields starting to get pulled up as they start to factor in that increase in rates. But what does the central bank do? Does that mean that they're going to have to get very long dated bonds? We've already seen how they've talked about yield control to try to mitigate against some of these increases. But when you look at just the shortfalls on government debt levels and in terms of the shortfalls on budgets, debt is increasing. So are central banks going to have to increase their debt buying? And if they do, what does that mean for the underlying system? And I think that we're at these crossroads right now.
Well, I think that ties it up together very nicely with the beginning conversation. We have a grid problem with reliability and balance and a whole bunch of moving parts. And we have an interest rate problem with a debt overlay that together, as we see one go, we may see the other go, and it's going to be a very interesting next month for sure. I am David Ramsden Wood. I am with Mark Rossano. Tune in for the Primary Vision show on all of this data, much deeper dive. And until next time, thanks for joining us on the pregame show.
Thank you.